Hi ladies and gentlemen, this is Game of Trades, and this is going to be a technical analysis of the S&P 500. So we can call this the 2020 wedge. We have seen a huge wedge pattern developing on the S&P 500 on the daily chart and on the hourly chart. This is called a bearish rising wedge. You'll see a price contraction as we move up, as we bounce along this trend line that we formed since the beginning of this rally. You can see this line here clearly shows a contraction in price. And what does this mean? This means that the momentum to the upside is waning down. You can see the MACD is starting to curl down. We're at the zero line, so we're starting to hit resistance on the MACD, and we're likely to see a shift in momentum. On the hourly chart, you'll see there is hourly divergence with the MACD and the RSI, and that typically means an imminent reversal on the shorter time frame. Now what we need for this pattern to play out is a break of this trend line support here. If we see a solid, clean break of this trend line, we will very likely see a move down in the markets, and we could potentially start our move down to the targets we've aligned. Now, how far down we'll go is the question I'm going to be answering in this video. I'm going to be covering a lot of things that might come into play over the next couple of weeks, including the tech earnings that are going to be announced this week and the reopen of the US economy and how that might come into play over the next couple of weeks as well. Of course, we are still looking for a long-term break of this 272 level, which coincides with this bull market uptrend line that we've been looking at extensively on this channel. If the markets manage to take the price back below these two important levels, that will likely trigger moves down much lower. So I am absolutely still looking for short opportunities in the markets. I think the risk reward is much more favorable to the downside. Now, I completely maintain that I have absolutely no interest in going long on the stock market. This is not an economy that I am confident in. This is not an economy from a fundamental standpoint that I want to be putting my money in to the long term. So I am still looking for shorting opportunities in the markets. Now, of course, I could be completely wrong. This is completely my own opinion. So please do make your own research before investing into the stock market. Now, as traders, we absolutely need to keep an open mind. We need to be on the watch out for potential bullish technicals. So that's definitely something to keep in mind. If we come down, if this wedge breaks, we see an impulsive breakdown, we come back down to this 11-year bull market uptrend line and we bounce off of it, that's a check mark for the bulls. That would be a bullish scenario. And that would absolutely put into questioning the retest of the lows in the short term. I do still believe we are heading into a longer term recession over the coming months and years, but obviously we have to keep our time frame in mind and not ignore some potential bullish developments. Now, there's a lot of things happening in the markets and a lot of things I want to talk about, so I'm going to get into the details of that. Before I do so, don't hesitate to drop a like. It does help out the channel tremendously. It is greatly appreciated. Now, the S&P 500 is very tech heavy. We've got tech earnings coming up this week, a lot of big companies reporting their earnings. And so for that, we do need to take a look at what the S&P 500 is composed of. We've got the 5 main companies, which are Microsoft, Amazon, Facebook, Apple, and Alphabet. Now keep in mind, Microsoft, Amazon, Facebook, these are all businesses that are very online based. These 3 are very online based. You can discuss Apple and Alphabet because they provide more physical products to the consumer, but these are online based. So we might not see their earnings get affected as much by the shutdown as other sectors in the S&P 500. So that's definitely something to keep in mind for this week's earnings. Obviously, there's the Fed that has a big part in this big rally, but I think the markets are pricing in a very good earnings week for tech. And we can take a look at QQQ. This is a very tech-heavy ETF. QQQ has clearly made a very impressive move off of the bottom. In terms of Fibonacci retracements, we can take it from the high to the low. we're way past the 61.8% Fibonacci level. So we're not in bear market rally territory anymore. So clearly fundamentals are pushing this rally higher, especially in the past few days where the markets have really started to take out some important levels. I mean, back here we were at the 50% retracement level, and I've been a short trader on the markets for a long time now, and this is where I really expected a reversal. This is where I think the S&P 500 and the QQQ should have reversed. We clearly broke out and we're heading higher now. This clearly has fundamentals priced in for earnings week. Now, don't get me wrong, I do believe that we're still heading in a longer term recession. I think the worldwide economic shutdown was the catalyst to start a multi-month, multi-year bear market, and that the dominoes have started falling. But before we see real economic indicators start to turn around, we may have to wait more than just a couple of weeks to really see the effects of the end of the business cycle. Now back to the S&P 500, do I think a massive drop in price at this rate of descent is possible? Absolutely. And I'm going to explain exactly why. We are 2 weeks out from the theoretical reopen of the US. I know many states are starting to reopen parts as early as next week. For example, Texas is trying to get early on the economic reopening. I think this is going to be a pivotal point for the stock market. The S&P 500 is clearly pricing in a reopen of the economy in the coming 2 weeks. That's what's being priced in. That's what's being predicted by the markets. So if we take a look at every single country where the epidemic is present, where it started, we'll see there was a systematic extension of the economic shutdown. We saw it with Italy, we saw it with France, we saw it with Belgium, we saw it with multiple countries. So why would the US be any different? If we do see an extension of the economic shutdown sometime next week, sometime in the next couple of weeks, let's say around here, that is when we'll see a massive drops in price. And that is simply because the markets will have to price in another month of economic inactivity. This was a month of economic inactivity, and so this will be another month of economic inactivity. So in that case, I do believe that we will retest those lows. However, I'm going to be clear here, and I do not think that we'll see panic without a news catalyst. We will need to see some kind of bad news for another big move down in the markets. Now, this is going to be a very interesting couple of weeks for us because we'll be able to see how the US reacts to the increase of the number of cases we'll see in states like Texas that are reopening much sooner than what medical professionals advise. And I'm going to show you a chart that I found to be very interesting, and that is the number of deaths in 1918 during the flu pandemic. And you can see we clearly had this typical exponential curve that you typically see with flu-type viruses. We had a number of restrictions being put on by the government, and here we saw a first peak in the number of deaths, followed by a decline in the number of deaths. And this is where it's going to get very interesting because we are going to see that sudden increase in the number of cases. We are going to see that sudden increase in the number of deaths. And this is going to be very interesting to see how they will react to this. Are they going to do a re-shutdown of the economy in order to stabilize the numbers? And again, this would likely provoke a second big decline in the stock market price. Now, will I be trading purely based on this information? Absolutely not. Will I be trading based on news? Absolutely not. If you've been following me for a while, you'll know I do not trade on speculation. I trade based on levels, breakouts, breakdowns, actual buy and sell signals. So as long as we remain above this bull market uptrend line, I have no reason to be short in the market. I am clearly waiting for a move down. I am clearly still waiting for a move down past this 272 level. Now, if you do more active trades like me. I try to cover more longer term trades on the YouTube channel, but I do actively trade the stock market, and a break of this trend line is a powerful sell signal to the 272 level. So if you do intraday trading, you can trade a break of this trend line down to the 272 level. That would make a nice 3 or 4% move down. Now, before I end this video, I am very glad to announce that there will be some changes coming to the Game of Trades YouTube channel. I've been getting a lot of demand in the comments section for a lot of different types of content. So I have been able to find like-minded traders that have been professionally trading for a long time to cover some of the content that you guys are asking for. Now, of course, I will still be putting out just as much content myself. This is purely so that you guys can get more analysis and more coverage across all different types of assets. Now that's about all I wanted to cover in this video. I hope you guys enjoyed. If you did, don't hesitate to drop a like and subscribe if you haven't already. Hit that notification bell if you haven't already and you want regular updates on the stock market. In the meantime, good luck on your trading and see you next time.